that investor would have achieved cumulative return of over 9,000%.
Crikey.
Bitcoin has already become less volatile.
Do a lot of investors overestimate their ability to time the Bitcoin price?
No investor should be trading Bitcoin from day to day. They'll try to time the market and they'll fail. When investors listen to me talk about Bitcoin and gold model, they usually say, okay, what does that mean for my portfolios?
Do you see Bitcoin catching up with gold in terms of sort of total AUM?
Bitcoin is not an alternative to gold. Bitcoin is a complement to gold.
Welcome back to the Investing Money and Markets podcast, brought to you by the Armchair Trader. And this week we're talking about Bitcoin and gold. Bitcoin often referred to as a new alternative to gold, but is that really true? Joining us on the podcast today, we have Dovile Silenskyte, who is with WisdomTree on their crypto team, who will be giving us a little bit more insight into this conundrum. So welcome to the podcast, Dovile.
Thank you very much for having me here.
It's your second time on the podcast, but you're obviously very close to these crypto markets at the moment. But first time that we've really compared Bitcoin and gold. But I wanted to really just start off with Bitcoin itself. I wanted to ask you if Bitcoin is less about trading these days and more about surviving volatility for long enough, because I am aware of the fact that there are some people who have lost money on trying to time the entry in and out. Is it just a case of just sticking with it?
Absolutely. And actually, I recently ran analysis where I took a look at cumulative returns that investor would have achieved if they went into Bitcoin at the end of 2013 and held until the 23rd of March this year. It sounds random date, but that was just the data when I ran the analysis. So if investor held Bitcoin throughout the whole time, that investor would have achieved cumulative return of over 9,000%.
Crikey.
But if investor missed 30 best Bitcoin trading days, that's 30, then the cumulative return would have been less than 30%. So over 9,000 versus less than 30, just by not having Bitcoin exposure over its best 30 trading days. That's a massive difference, and it's the best illustration of just staying in the market. You run the analysis, you decide how much Bitcoin you want, how much is appropriate for your portfolio, allocate, stick to your rebalance frequency, and that's it. Forget trying to time the entry or the exit, because nobody's able to do that. And if I was able to time the proper entry or exit into Bitcoin and out of Bitcoin, I wouldn't be here. I would be trading, but that's not a reality.
You've anticipated the next question I was going to ask you, which is, do a lot of investors overestimate their ability to time the Bitcoin price?
So in the past, Bitcoin was traded primarily by retail investors who try to anticipate when is the best time to enter, when is the best time to exit. Now, more and more Bitcoin is held in institutional hands. So when I take a look at the analysis that I run, just under 20% of total Bitcoin supply, which is 21 million Bitcoins that will ever be issued, is now sitting in sticky institutional hands. So there, investors are treating Bitcoin as they're treating any other asset class, which is, same as what I said in the previous response, deciding how much they need for their portfolios, allocating and sticking to that allocation and implementing it via proper rebalances.
Do you think that institutional participation is going to increase, and is it going to change the nature of Bitcoin so it becomes less volatile if there are so many big players who are just going to buy it and sit on it?
Bitcoin has already become less volatile. So this morning I took a look at its realized volatility, which is 90-day annualized volatility, and it was under 40%. In the past, it used to be 70 to 80%. Bitcoin's implied volatility, so volatility looking forward, is also at 8-month low. So Bitcoin has matured, it has become much calmer, and it's very much macro asset, similar to gold.
And when you say macro asset, what do you mean by that?
I mean that in the current investment environment, instead of trying to follow hypes that are within the crypto market, investors take a look at what is the macro investment case for Bitcoin. What is inflation? What are the real rates? What is where is US dollar at? So they take a look at the key macro factors and decide how much Bitcoin is appropriate.
What's amazed me actually, because I've been following Bitcoin for 5 or 6 years now, and it's actually much more highly correlated to other financial markets than I expected it to be. Even geopolitical events can cause Bitcoin to sell off, and you just have to ask yourself, why are these guys selling this? Because this is not really fundamentally going to affect the supply of Bitcoin.
So Bitcoin sells off during big events. For example, when a conflict starts, sometimes countries that are involved in that conflict, for them to access liquidity, the easiest way to do that is to sell crypto, and they hold Bitcoin as a key allocation. But to address your volatility and correlation point, I run correlation analysis for Bitcoin versus traditional assets, and I run that analysis using weekly performance figures. And when I look from the time period from the end of 2013 to the end of last month, so the end of April, Bitcoin is not correlated with traditional assets. So Bitcoin's correlation with gold, for example, is 5%. This is nothing. Bitcoin's correlation to equities is around 20%. Correlation to fixed income is lower than that, and commodities is lower than that. So Bitcoin is not correlated to traditional assets if you take a look at over extended time period. And when I compress the time period to 2 years, the story remains the same. Of course, on any individual day, Bitcoin moves together with other risk assets, but no investor should be trading Bitcoin from day-to-day basis, because once again, they'll try to time the market and they'll fail.
And I wanted to get on to Bitcoin's role as a possible alternative to gold. I've heard a lot of investors talking about how Bitcoin is going to be used as an alternative to gold. Do you think that's true? Do you think it's still undervalued relative to gold? Do you think institutional investors see it as an alternative to gold?
So Bitcoin is not an alternative to gold. Bitcoin is a complement to gold. And actually, I've spent the last few months building out Bitcoin in gold model that takes into account the current macro environment and sees whether Bitcoin is undervalued or overvalued versus gold. So at the end of first quarter this year, the model showed me that Bitcoin was 26% undervalued versus gold. And the model considers 12 different macro scenarios, and it showed that the current macro scenario is likely to continue over the next 12 months. The other two most likely macro scenarios was inflation shock and risk off. And under both scenarios, Bitcoin should catch up with gold with respect to valuation. So the difference between Bitcoin and gold pricing should narrow. But when investors listen to me talk about Bitcoin in gold model, they usually say, okay, what does that mean for my portfolios? And I say that that model is in no way built to time the markets. Now is the time to enter or exit Bitcoin or gold. But it shows how investors could try to position their portfolios. For example, when Bitcoin is significantly undervalued relative to gold, considering the current macro environment, maybe investor may want to go long Bitcoin, short gold. Or maybe investor may want to overweight Bitcoin and underweight gold within their portfolios. And when I say overweight and underweight, I take a look at the market cap neutral portfolio. And at the end of April, the market cap neutral allocation was 1% to crypto or Bitcoin and 12.2% to gold. So Bitcoin represents much smaller portion of a market cap neutral portfolio. So for investors who want to be, passively tracking the market. So if that investor sees that Bitcoin is significantly undervalued relative to gold, maybe they want to increase allocation to Bitcoin from 1% to something more and reduce allocation to gold from 12.2% to something less.
And looking at Bitcoin and gold together, obviously Bitcoin, one of the things investors prize about it is there is always going to be a finite supply of Bitcoin. At some point, hypothetically speaking, we're going to reach this stage where there will be no more Bitcoin to be mined. Gold, on the other hand, there is hypothetically a finite supply, but they are still adding to gold, as mining techniques improve, as new gold seams get discovered, there is the potential for more gold to come onto the market. There isn't that same mathematical certainty with gold as there is with Bitcoin. Do you think that that slightly changes the dynamics between the two?
So Bitcoin's supply is capped at 21 million Bitcoins, and this figure should be reached in 2140, so in just over 100 years. And now we have over 20 million Bitcoin issued. So it took us 17 years to get to 20 million plus, and it will take us over 100 years to mine the last 1 million Bitcoin. So the issuance of Bitcoin is reducing significantly. And most of you may know about Bitcoin halving, when Bitcoin miners get their reward cut in half more or less every 4 years. Gold does not have any programmatic cap on its issuance. And actually, when I say gold issuance, it's people actually digging gold from underground. But there are economic factors that need to be considered in how much gold can be mined. Because even though some mines are there, they're not economical to access, or they are too environmentally unfriendly to access. So gold's issuance, in my eyes, is also very much capped, because there is only so much gold that people and institutions can dig out of ground every single year.
With spot Bitcoin ETFs now established in the market, do you think that that's going to make it more attractive as an asset class for institutional investors as well? Because it just provides them with a much more easy and regulated avenue into Bitcoin than other traditional avenues.
Absolutely. And I spend a lot of my time talking to institutions and trying to educate them that once they see that having small Bitcoin allocation within their portfolios makes sense for them, then the best way to implement that allocation is via exchange-traded product wrapper. And I say this because exchange-traded products, they are listed on regulated exchanges. They have prospectuses and other proper documentation around them that describes how they function and what protections there are for investors. They also have clear costs. So for example, management expense ratio is clearly disclosed, and bid-offer spread is also clear when an institution wants to trade Bitcoin exchange-traded product. So there are fewer surprises that frequently come from investing in direct Bitcoin exposure. And also, most of the institutions, when they allocate to Bitcoin alongside other traditional assets, they want to be able to easily monitor risk, compliance, performance. And that's only possible if they invest into exchange-traded product wrapper instead of going into Bitcoin directly. Because direct Bitcoin exposure sits very much alongside traditional investments, and it's impossible to have an easy overview of the whole portfolio.
And following both the gold and Bitcoin ETF market, I mean, both have done incredibly well. Huge amounts of money going into both sectors. Do you see Bitcoin catching up with gold in terms of sort of total AUMs and actually beginning to play a much more important role in institutional portfolios than it has previously?
I think it will take a long time for Bitcoin to catch up with gold, because gold has been with us for thousands of years. Gold has earned its value. We value gold. We value it personally. We value it from a portfolio perspective. We have been using, we as humanity have been using gold for thousands of years. We're familiar with it. Bitcoin is still relatively new. And even though institutions are starting to allocate more and more to Bitcoin, and their allocations are sticky, it will take time, for example, for central banks to start allocating to Bitcoin. Few of them, such as Czech National Bank, they're running pilot cases to see whether having Bitcoin makes sense from compliance operational perspective. But it will take a long while for those institutions to get to the stage where they are allocating as much to Bitcoin as they currently are to gold.
Do you think other alternatives like stablecoins, for example, or these experimental central bank digital currencies could end up being a competitor to Bitcoin for institutional investors?
No. So stablecoins is the same as cash. Because what stablecoin is, it's a token that's backed, most of them are now backed by US dollar. So if the institution wants to have US dollar exposure within their portfolios, fine, invest into stablecoin. But if they want to have growth, if they want some performance impact from having crypto allocation, then Bitcoin is more appropriate for them than stablecoin, because stablecoin will stay at the value of the underlying currency, fiat currency.
Understood. Do you think Bitcoin will be a beneficiary from some loss of confidence in fiat currencies? Again, going back to its slightly gold-like characteristics?
Absolutely. And this is fascinating consideration from macro perspective. Because, for example, in the current environment, where inflation is once again very visible, Bitcoin, same as other risk assets, are not performing as well in such inflationary environment. But over longer time period, once investors start to recognize that inflation is here, inflation is sticky, inflation will mean a lot more of money printing, they will once again start to assign more value to Bitcoin and want to make allocations to hard currency assets such as Bitcoin and gold. So in this environment, Bitcoin and gold very much compete for institutional portfolios allocations, but both of them deserve serious consideration in macro environment, the one that we're in now.
And finally, I just wanted to ask you about the regulatory environment for Bitcoin, particularly in the US, where we've seen a lot of reforms being ushered in and transiting through the legislative process at the moment. Do you think that that's going to be beneficial for Bitcoin in particular?
So for Bitcoin in particular, I think there is already enough clarity for large institutional investors to be able to feel comfortable about having Bitcoin within their portfolios. Of course, there is a big development in the US that has been a work in progress for the past year or so, which is Clarity Act. And a large number of individuals are hoping that Clarity Act will be put into law later this year. But that is not necessary for institutions to feel comfortable about allocating to Bitcoin and making those allocations via exchange-traded product wrapper.
Great. No, that's fantastic. Well, thank you very much indeed for coming on the podcast today, Dovile. That's been really informative.
Thank you so much for having me here.
We hope you enjoyed this podcast. Like and subscribe to our channel for more great investing ideas. You can find us on thearmchairtrader.com, as well as on X, Instagram, and TikTok. You can subscribe to our free newsletter for news, insight, and tips to help you navigate the financial markets. The content of this podcast is for information and entertainment purposes only and does not constitute financial advice. The views and opinions expressed by guests or hosts are their own and do not necessarily reflect those of the Armchair Trader. Investments can go up and down in value, and you may not get back the amount you originally invested. Past performance is not a reliable indicator of future results. We do not provide any personal investment, tax, or legal advice. Always do your own research or seek independent professional advice before making any financial decisions. The Armchair Trader is a media company and is not authorized or regulated by the Financial Conduct Authority.